Hey everyone, this episode is brought to you by Mantra, the security first, compliance focused L1, which is onboarding the next wave of financial institutions. You're going to be hearing all about them later in the show, but for now, Mantra, thanks for making this episode possible.
All right, welcome back to another episode of On the Margin. We're recording here right on market close, right after the FOMC meeting happened today on Wednesday, July 31st. And I'm joined by Dayan, returning guest. Happy to have you. What's going on?
Well, busy day, obviously, with the Fed, so a lot to talk about. I'm glad to be on.
Let's get right into it. We had the FOMC meeting. They left rates unchanged, which was largely as expected. Quite a few changes to the actual press statement itself, and then obviously a ton of implications that occurred during the press conference as well. I'd love to just get your high-level takeaways from starting with the rate decision and the press statement, and then we can get into some of the outcomes from the conference that you saw as well.
As you kind of alluded to, they didn't hint directly at, a decision in September, but he did hint that, they're leaning that way, essentially. That the data is moving in their direction, that if they see more of it, they are likely to ease, whether it's September or November, they're ready to go. But I thought actually he was a little bit more neutral than the market reaction gives credit to, or social media reaction gives credit to, partly because the media just bombarded him with every single time. Every question was exactly the same. It was all about rate cuts, when rate cuts, why not now? Every single question is exactly the same. And he's a willing speaker, and he's going to answer these questions. And so it comes off as dovish. But I thought there were a few interesting things from what he was saying to me that I was happy about. And there's also a couple things where I think, this is where there could be a potential mistake. Number one is, he talked about the economy being in balance. He didn't say the economy is weak. A lot of people think the labor market is weakening, they're behind the curve. He didn't say that at all. He was more that it's in balance. It's still good growth. It's still a strong economy. It's just that inflation has come down and there's been some softening in the labor market. He compared it to, sort of the 2018, 2019 labor market. And we know that their view is that policy is restrictive, although he did caveat and say we're not deeply restrictive. I thought that was an improvement, and he said that in Congress as well. But we do know that they think the neutral rate is 2.75, 3% range, and so they want to remove restraint. But he said specifically, we don't want to loosen policy, and so I think this is where I have a little bit of disagreement with them. But overall, I think, absent a call it 0.35 core CPI print next week, or 275K NFP print, I think they're ready to go. It would take some kind of real shock for them not to go, frankly.
Pretty quickly into the conference, there's questions coming up about some sort of indication of whether they would decide to cut in September. And it seems like he has so much of a pre-written statement around that to say that, if there was enough continuation of the same sort of data that we've been getting in, it looks like that could well happen. That's different from, as you say, a full-on loosening and cutting cycle. It seems like he's really framing it as normalization. Could you just break down the difference between those two? And what do you think they're actually trying to achieve with, say, one rate cut? And just the distinction between that and the sustained rate cutting cycle, which is what the market's currently pricing in.
This is exactly my biggest disagreement with both the Fed and the markets. By all measures, the economy is quite strong. That doesn't mean that there aren't certain parts of the economy that are weak or softer, and other parts that are doing quite well. We know about the wealth disparity, where high net worth people, are making great returns in their asset portfolios. Their homes have appreciated in value. Their mortgages are locked in at low rates. Certain low income brackets are struggling with things like credit card bills and whatnot. There is that dichotomy, but it's important to kind of characterize this. A year ago, we had pockets of weakness too, right? A year ago, we had multiple bank failures, right? Like that's something that was pretty weak, and people extrapolated that to recession. I don't see, that sort of weakness, now either. Frankly, even with some softening in the labor market, we've printed pretty consistent nominal GDP around 5.9% for 5 quarters. Since they've been above 5%, we've printed consistently around there. And the highest was 6.2, the lowest was 5.5. There's not a lot of variance. It's pretty consistent, strong growth. This is sort of the Bob Elliott, income-driven cycle, and wealth, is obviously a big support as well. And frankly, fiscal spending is a big support as well. So the economy overall, remains quite strong. And then it comes down to, what are you trying to accomplish if you're the Fed? So even though I may disagree with where they think neutral is, they think it's lower. They have seen some softening in certain parts of the economy, and they think, let's remove restraint, right? They don't think that they want to loosen policy, but he said that today as well. He said, let's remove restraint. Now, historically, that's 2 to 3 cuts. So in the 90s, you had 2 cuts. They then were on hold for years. In 2019, they did 3 cuts. And, frankly, those were kind of unnecessary, if you ask me, in 2019, because the cuts themselves were driven by, a policy choice of trade wars. And so, it was an actual desired policy by the government. And then, the Fed was trying to offset this by cutting rates, which wasn't going to help, in my opinion, but that's another story. But so adjustment cuts is that. In as hawkish as I am probably able to admit that if they were going to deliver 2 cuts in 50 basis points of reduction, this is not going to lead to a second wave on its own. You would need something else as a catalyst, something that is hard to predict. Does lending pick up rapidly? Do we have a supply shock, due to geopolitical dynamics or something like that, to get you a second wave? The issue I have is that we're not pricing adjustment cuts. We're pricing a full cutting cycle. We maybe aren't pricing a deep recession. Deep recession would be 350 to 500 pips historically. But, we're pricing 200 by starting in September till the end of next year, give or take. That's 15 months. That's pretty aggressive, considering the economy as it is today. And so, this is where I think he didn't push back on that. Maybe it's just the questions he was asked, but he didn't push back on that at all. And this is where I think it's going to be their doom. Asset, prices are really haven't corrected much at all. We did have a little bit of a scare in the markets, for a few days or 2 weeks, call it, but we're 3% or 2.5% from the all-time high, so can't really call it much. And then, we have these very, very deep cuts priced in. And I think the way it'll play out is, as soon as they deliver the first one, because there's been a number of head fakes on this, right? So if you're a business and you're out there and you're like, oh, rates are coming down, but I've heard this before. I heard this in January, I heard it in March, didn't happen. I can't plan for that unless it actually delivered. But once they deliver the first one, those next 200 are fully priced in. And what you'll see is they're putting a floor under the economy. So again, I might disagree with a lot of people on the downside risks. I don't see a lot, but the whatever the downside risk was, they're putting the floor under it by cutting rates, especially that aggressively. And we can just walk through the dynamics. We have a 4% unemployment rate, and you're putting a floor underneath that, underneath the employment situation. Well, if you're a small business and, margins are starting to bite and you're like, I'm going to let people go, obviously you won't anymore. And that's a good thing. That's what they want to accomplish. But you also have businesses that say, I'm holding off hiring people, that will now look to hire people. And so, those businesses will hire. And so, this is where it's a little baffling to me. What is your objective? 4% unemployment rate is too high and you need to cut rates. So do you want 3.5 again? Because we're going to go right up the beverage curve. We're going to see wage inflation. Again, we don't really have inflation coming from wages. I agree with Powell on this. in the labor market, but we can easily get back there. We're not far, right? We're not Sweden, which has a 9% unemployment rate, as an example. They're cutting. We're not Canada, has a 6+ percent unemployment rate. So there's not a lot of slack in the economy. In the aggregate economy, whoever's doing well will certainly continue to do well, if not better, by lower rates. And then whoever has been struggling will get a boost from lower rates, lower financing. And so, nominal GDP 6. What do you want? Do you want 6.5, 7? How do we get that without the economy overheating again? And so these are the things that I don't think they've thought through well, and that their myopic, formula around their neutral rate has them say getting back to 3% will be completely harmless, will not stimulate the economy. And that to me makes no sense at all.
Hey everyone, this episode is brought to you by Mantra, the security-first, compliance-focused L1, which is onboarding the next wave of financial institutions into Web3. So you guys have heard me talk about Larry Fink talking about tokenization. You've seen the clips on CNBC. You know that Larry and BlackRock are very, very excited about this idea. And the reason for that is they're looking at these trillions of dollars of off-chain real-world assets. They want to digitize those and bring them on-chain, which is going to be a massive opportunity. But in order to do that, they need a compliant L1, and that's where Mantra comes in. Mantra's been steadily climbing the ranks and now stands among the top 4 RWA projects on CoinGecko, which is representative of its rapid growth and influence in the tokenization space. Mantra is built using the Cosmos SDK, so they have some very cool stuff out of the box. They've got IBC interoperability. They also leverage CosmWasm smart contracts. Very cool design from an architectural standpoint. The next phase on the blockchain's testnet is Hongbai, so that's launching soon. So if you're a dApp developer or something like that, there's a lot of very cool opportunities for you, and I highly recommend that you click the link at the bottom of the show notes. I don't know that I sent you. Thanks very much again, Mantra, for making this possible. And again, guys, click the link at the bottom of the show notes.
Yeah, I think to summarize a few key points there, it sounds like, their framework is they're probably going to cut in September. Past that, there's very little guidance. You maybe had a little hint about a few more cuts, but really, you didn't want to put that too much onto the table. But it seems like that plan that they have right now is based on these, data-driven points. And the issue is that it sounds like 2 of these data-driven decisions are one about the labor market and one about neutral rate. Your view is that the neutral rate is higher than they actually suspect it is internally. And secondly, a lot of the increase in the unemployment rate in the labor market has been due to these idiosyncratic factors that you're talking about. So those 2 aspects could set them up for what sounds like a potential policy error. The single cut itself in September is not necessarily going to increase and reaccelerate the economy, but that continued pricing into further cuts and the cascade of effects might. So it sounds like that's setting up for what you think is a potential policy mistake in September. And do you think that leads to this second wave 1970s style of inflation?
Not 1970s, and I don't think any 2 periods are alike. There's unique situations about the 1970s that you're not going to get the degree of oil prices, from the embargo that happened from the Gulf states, in that time period. You're not going to get something like that, especially because the U.S. is the biggest producer in oil. So you're not going to get that. You can get oil easily go to 100. You could get that. And you're not going to get the depegging from the gold standard that you had there, which basically was a huge increase in money supply that was fixed and was no longer, or quasi-fixed that is no longer fixed. So you're not going to get those dynamics. But you could easily get back to, a 4 or 5% inflation. And, that would be a problem in that you may have to reverse cuts. And so to me, I think given how strong growth is, right? I know their mandate is the labor market and their mandate is inflation, but let's look at this for a second. They're still above target on inflation, right? Firmly, like they're not there. Especially like CPI is higher than PCE, and I think they should be careful with only relying on one, not the other. I understand that they like the one measure better, but if they give you 100 pip difference I would be careful with interpreting. Right now, I think it's more like 50 bip difference, but it has been 100 for a while. Secondly, by all measures, they're at or near a measure of full employment. And they're roughly 180 to 200 basis points higher than what they estimate is potential growth. So all of these metrics would tell me that they should just be doing nothing. I don't think they should hike, but I think they should be doing nothing. And they should be studying a few things. Why is this cycle so much different than what everyone anticipated? Why are savings rates 5% lower than they were last cycle? Why are housing prices sticky? Why is the economy not rolling over, for a full year with rates at these levels? I think if they were to telegraph to the market, we're going to get 2 cuts in and then sit for 6 months unless XYZ happens, right? Unless the labor market falls apart or unless inflation falls below 2, whatever, I made it up. But unless we have those dynamics, we're going to sit tight and see how these first cuts get digested by the economy. I think that would be probably okay. But because we're pricing what we're pricing, and look, since the meeting ended, we've rallied another 6 basis points. Intense, right? And the other major problem for them, in my opinion, is that the nature of the curve, the yield curve, is still a problem that they've never figured out. I know you had Andy Constant on, I share a very similar view on the term premium, how that's been a problem. The curve shape since 2021 has, been an issue for them. And, today we bull flattened, right? That is the opposite of what you would expect. If we're, 2.5 months from cuts, first of all, he didn't say we're going to cut more than what's priced. So I don't see why the market priced more. We were already fully priced for September. So frankly, you shouldn't be pricing anything. You should just be, okay, he blessed what's out there. He didn't push back too hard. We're good. But instead, we're pricing more and substantially more. And the curve is bull flattening, which is actually reducing the term premium even further. And so as a result, in my opinion, this is the nature of what will be their doom. And why I think at some point in 2025, they'll have to pause and potentially reverse, along the way.
Shifting a little bit of gears here towards what you just mentioned in terms of, we've been seeing this bull flattening occur. There's no talk today about the continued quantitative tightening that's been occurring, but they did, start to taper that recently. We did also have the quarterly refunding announcement come in this morning from the Treasury side of things, and it looks like coupon issuance is going to stay pretty much in line with what they guided, and they don't plan to increase that further. But I'd love to just summarize, a little bit more about how those two dynamics, the recent announcements from the QRA today, as well as, we didn't get any new news on QT taper, but is still ongoing, how those two things are affecting that long end and how that can tie into, spelling the doom that you're talking about in terms of that, like, potential term premium expansion.
So QRA, like you said, non-event, coupons, there's still a ton of issuance, right? And I think this is going to be a continuous issue. I would kind of note that the issuance is a problem when the economy is really strong and when, there's a risk of higher rates. When people think we're going into a recession, like the markets think, not what Powell thinks, but that's what the markets think, that we're heading into a recession and it's a mistake. There's always going to be demand for treasuries, even with the higher issuance. So I don't view that as a problem, other than, auctions are going to still be maybe a little bit messy here and there, but otherwise it's a non-event. The QT is also a non-event because the mechanics of QT has nothing to do with the 5-year or 10-year or 30. It has to do with T-bills rolling off. So you have T-bills that roll off. The Fed gets paid back by the Treasury, whatever it is. Like if $1 billion rolls off, they get $1 billion in dollars. and those dollars are then used to return the reserves to the banks, right? And so there's really nothing that affects, term premium from that standpoint either. It really hasn't this whole time, and is part of the reason I think they haven't done policy the right way, this cycle. So I think, this remains the biggest issue. When we've been in prior cycles and we're at the last, let's just say 3, 4, 5 months before cuts, you would typically get a decently, bull steepening, because the back end of the curve would start to reflect, you don't actually get much of a reduction in long end rates when they cut rates historically, because now that they're cutting, we're starting to price the next cycle. We're starting to price growth being better, inflation being better, and somewhere down the line, we'll be raising rates again. And so, the market's not pricing that at all. The markets are, just in buy everything mode. And I think we're overdoing it again. I think we're overdoing it again. It's going to backfire. I think asset prices are going to continue to moon. And so as a result, I think everyone's misjudging this sort of softening in the economy. All that said, I do think there is some softening in the labor market. It's just that it's not where I would be cutting rates. The labor market, as I mentioned, there's, all these things going on, and I think we would still be below 4%. But you do see a decline in something like the quits rate. And you do see a decline in private sector job creation, slowing in it, not negative, but slowing in it. And, these are signs that either the economy, doesn't need more workers, we're at the capacity we're at, or that there's a potential slowing coming. It's just that it'll come very, very slowly. And, that is being extrapolated to recession. And now we're pricing recession again. And so I think the bond market's just overdoing it.
What do you think is the trade here? Is it, shorting twos and fading, the market pricing in that the Fed is going to cut 200 bips amount when really they're only going to cut 50 bips amount or something like that? Or is it shorting the long end and expecting a rebound in the economy? Is it spreads, or how are you starting to look at these dynamics?
Yeah, I think it's the front end all the way to the belly more than the back end at this point. The back end is, a term premium story, and sure, I think it should be wider, but at the same time, what's the catalyst for it? I struggle to see what a catalyst is for it. I think a potential catalyst for the back end to go ballistic is, let's just say we get 2 more quarters of GDP at these levels, that, payrolls continue to be strong, inflation continue to be sticky around 3%, and that the Fed doesn't cut. Well, if the Fed holds off on cutting and says, hey, we just continue to see things as too strong to go this meeting, and then the next meeting they don't do it again, and we get to something like November, December, then, I think the market will effectively reprice the neutral, itself. But right now, I don't see why that's going to happen. So to me, it's the front end. All that said, I've been trying to fade this. It's really hard. It's really hard because the markets are a one-way freight train. And I've tried to do it in option space and I'm underwater on these positions. I put them on the last couple of weeks, but where you have some staying power. So, effectively, Z5, that we don't get below 3%, type of trades like that, or by June, we're not at 3%. I have like these sort of like short call spreads. They're limited loss, but still, I mean, the mark to market on them is brutal. It's been brutal the last couple months, but, I think it's not easy to stem the tide, just like when they were hiking every meeting, you knew they were hiking. It's hard to buy bonds. You might time it well and get it, but it's really hard to do it. And now the markets are, rate cuts, obsessed. It's hard to do this. So these are trades that I anticipate I probably have to have on for, 6, 9, 12 months. and that's kind of difficult. Not everyone has the stomach, for that, frankly. And if I were trading institutional money, I don't think I would be putting on those trades. I would be doing them a little bit differently, or waiting for my spot. But with personal capital, I'm more patient, and able to wait it through. But it's not fun. It's very hard. Um, I actually, and you know me, I'm a trader. I switch my views all the time. I wrote yesterday equities are a lose-lose, and that already looks stale one day later. Not because of today's bounce. That could have happened regardless when you had the Nasdaq down 3+% yesterday. But the nature of just earnings expectations are just too high, and we were starting to see that even Microsoft beat. They had very high capex, and the initial reaction was down 8% in after hours, like instantly. And this is Microsoft. This is like the preeminent company that we have in our market. And so there was weird fear that Nvidia will be bad, and we started to see fear over earnings. And if you're getting fear over the tech behemoths, to me this is a bad sign for like other businesses. All that said, frankly, with what the bond market is doing, it's very difficult to be short stocks here. You can sit it out, but I wouldn't say you want to be short. I'm long. I flipped long, and I probably will be long for a few weeks. But we'll see. We'll see how it plays out. I'm very quick to take profits when they're there. But I think that you have to stay in that. I think the dollar, overall should be weaker. Although the hard part with this trade is, what do you buy? Right? Because, look at what happened last night with Australia. They were priced to hike again. That got wiped out. Boom, they went down 70 basis points, very quickly. New Zealand had a good day because their business outlook improved substantially, but it's down, very big in the last number of months. The Canadian economy is weak, and if anything, the Bank of Canada, was surprised me is that they're more likely to move quickly rather than slowly. So, how do you be long the Canadian dollar? How are you long the euro when their GDP is under 1%? They do have sticky inflation. The UK seems like the cleanest long, and they're still expected to cut tomorrow. And so you have a really tough time with like finding these, trades that make, no-brainer trades for this. And I would say equities probably remain the only show as a result because, if the economy's growing, if they're loosening policy, it should be good for stocks. I think the earnings story will hit at some point. And I think the financial condition story will bite the Fed in the behind at some point in a very, very big way. But that's not today.
Hello, listeners of On the Margin. I've got good news for those of you who are in the crypto scene. Blockworks is bringing back Permissionless. We're going to be doing Permissionless 3, and this year we are heading west. So we're moving that out to Salt Lake City. That's going to be October 9th through 11th this year. We've got a phenomenal lineup of speakers for you. So we've got Balaji headlining. We've got Sriram, Munib, Matt Hogan of Bitwise, Jan Van Eck. This one's going to be a blast, guys. And I saw many of you out in London for DAS this year, and I hope to see you out in Salt Lake for Permissionless. And because y'all are such faithful listeners, if you use code MARGIN10, you're going to get 10% off your tickets. Appreciate you all. Hope to see you out there.
Yeah, let's talk a little bit more about equities there. There's obviously this earnings story that you've been talking about. We've been getting the tech earnings. And like you said yesterday, Microsoft beat, but still went down pretty significantly. I think I just saw that Meta came in and potentially, they had a loss in their reality lab sector. So there's a lot coming in right now as we're talking. But then there's also been this interesting story of what's been going on in these major rotations between the different sectors. There's been some speculation that is it the unwind of the yen carry trade. The Bank of Japan actually finally hiked rates yesterday, which was really interesting. some people are speculating that reversal and strengthening of the yen is leading to people that fund U.S. Tech equity longs are having to unwind that position. I've also seen talk about the long the Q, short IWM kind of trade has obviously started to create some squeezes. Would love to just hear a bit of an explanation of what are these dynamics that have been occurring, and what do you think has been these big drivers of this under the surface violence of rotations we've been seeing in equities?
I think we've gone into a paradigm shift where we were in this sort of Goldilocks where, we do have 5+% policy rates. The economy remains strong, but it's a bit of a bifurcated economy. This favors, the big players, the big tech companies, the companies that have a lot of cash on their balance sheet. So that story just made so much sense for so long that, it took a shock, which was the weak CPI, to say the story's changing. And so the story's changing to the point where the Fed is going to be cutting. Well, instantly the market, with this and the odds of Trump winning, you had two factors. The two biggest things that are affecting small companies, small businesses is, financing costs and taxes, and so if you get those two going in their way, small businesses should outperform. And, that's still a far away story, but that's how the market took it, right? Like the earnings are not going to be exciting for the next few quarters. Like it'll take time for this to play out if that's the way it'll play out. But the markets basically underwent a series of VAR shocks. So I think it's less about trying to fit an explanation and just understanding that you had a lot of really crowded positions on, and these positions, have blown up on people. And, part of it is the nature of the hedge fund industry has changed quite a bit. Most of the capital these days is concentrated in, what we call the multi-strats. And, they're great
Pod
shops.
shops.
Yeah, pod shops. They're great shops.
Mhm.
There's obviously huge advantages for portfolio managers to go work there, but at the same time they have very strict risk limit profiles that they impose on managers. And what you find more often than not is you're not seeing big directional trading from guys. Like you're not seeing like equity long short, but I'm like 200% long. No, you're mostly seeing like market neutral. You're seeing, interest rates, the DVO1 neutral, delta neutral, so they're mostly trading curve and flies and RV and things of that nature to, pick up small P&L here and there on a more consistent basis. So it's less about the big macro themes and, big punting like that of risk. And so they have very short leashes. If you have a trade and it moves against you a little bit, you want to protect your profits or minimize your loss, because even if this is the greatest trade in the world 6 months down the line, you're not going to have that staying power the way that you would if you were at, like, for example, an individual hedge fund. And so, what happens is there's so many people that have these same trades on, and they get unwound at the exact same time. So, the long mega cap tech versus short, regional banks, short, financials overall, short small caps, short, cyclical sectors like, industrials. All of this just kind of got unwound in such a rapid way. You had, in FX, like you said, dollar yen was like the favorite carry trade. It wasn't just dollar yen. It was also cross yen. MXN, Mexican peso versus yen, Brazilian real versus yen, CNH versus yen. It was all these currencies. Everyone was using the yen as the short leg because it was positive carry to bet on that. And you're just really not getting carry anywhere in our entire financial system. Typically you want to have carry and you want to have growth and you want to have a balance. And you're just really not getting carry anywhere. Even if you go to credit, the credit spreads are very narrow. So what you're actually getting is duration risk, not credit risk. You're not getting compensated for the credit risk. So If you're a credit portfolio manager, you're not benefiting from carry because spreads are so tight, unless you can just buy bonds outright. So nobody really has good sources of carry. Obviously, the inverted yield curve is a big reason that we have that dynamic. But these carry chains just blew up, on people. So it's just a VAR event, and it just takes time for these things to get cleaned up, and then they get cleaned up, and then the markets move on, and something else will get crowded. And I don't really know what that'll be. I think the dollar short might be one of the next ones. Although, as I mentioned, like which currency do you really want to buy? I think precious metals probably get another bounce here. I think in general, commodities as a whole are probably going to get another look here, especially with them loosening policy. Personally, I think bonds are absolutely atrocious deal. And I don't know who wants to buy a 10-year at 4%. I can't believe we're back at 4%, but we are. And I think that's an absolutely terrible deal. The old rule of thumb is the 10-year yield should approach nominal GDP. Well, nominal GDP is 5.9, and the 10-year is at 4. It's just an absolutely horrible deal with no term premium, no compensation for that extra duration. So it seems a bad deal. I don't even think the front end makes any, like we talked about this, but I don't think the front end makes sense. I'd rather be in T-bills for the next 3 months, or lock that in as much as I can, 6 months to a year, and try to just clip that rather. And I know I'll have reinvestment risk if they do move sharply lower, but the 2-year is priced for a substantial cutting cycle that I just don't think is going to play out. So I think it's going to get very complicated from here. And we may see a lot more of these like volatility episodes, because I don't think there's like no-brainer trading out there. To me, the no-brainer is short the front end, and as I mentioned, it's really hard to hold it. So let's just say if I worked at a multi-strat, I would have to stop out. And so, it's not like that makes it not a no-brainer, right? A no-brainer would be that you don't have to stop out. It probably has a runway of 6-12 months for you. I don't see anything that gives you that. It's going to be really complicated. I think equities are probably like the most simplest place to put your money, which is insane given how much we've rallied, given how expensive the market is, given how rich earnings expectations are. And I say this fully well that I may turn around in 3 days and flip short, as a trader. But I think from a put your money somewhere standpoint, it's a far easier story than any other asset class.
Awesome, Danny. So just to circle back to where we started this conversation to wrap up here, we had the Fed meeting today. It was marginally dovish, but probably not quite as dovish as many think. But, there was some inclinations about September happening. We have no Fed meeting in August, but we do have the Jackson Hole Symposium at the end of August. And then there's the September meeting. What do you think is, what would you say is how you see things going through the next few months? Do you see this continuous walk back of rate cuts from pretty much now? Do you think, Powell's keeping some optionality so he can use it at, say, Jackson Hole before that September meeting? What are your final thoughts here on how we go from where we are today until basically that September meeting?
Right. Obviously, we're all going to be watching the data. We get payrolls on Friday, and then we get, inflation next week. And, those will be very big, obviously in determining, how likely this is. And, I don't have a clue how the other members of the Fed are going to react to this, because I don't think that, we talked about this. Powell was measured in his tone on purpose. I don't think he wanted 10 basis point rally in the bond curve. I don't think he wanted that. I don't think he was as upset. They're not focused on equities, so I don't think he cared that the market was up 2% today, especially because it was down a lot yesterday. So that's not what they're worried about. But I think, I can't imagine they're happy that we priced additional cuts when he said we're still not sure about cutting. And he didn't provide new dots that said, more cuts, So I don't think that message came from the Fed, and I don't know why the market is running with it. So the question is, the Fed, which it seems they learned a little bit about their communication snafu in December, about preemptively telegraphing it. And I don't think he telegraphed today that a cut is a fait accompli is 100%. I think he said the way I would characterize it is, probably a little over 50-50, maybe like 60-40, 70-30 is how the Fed sees the cuts, a cut in September. But they're certainly not sure about the pace of cuts. And they're certainly not sure about committing to, okay, we did September, so we're also doing November and December, and then January, and then March, and blah, blah, blah. Like, we're pricing like 8 straight meetings. And I don't think that they have that certainty. So I'm going to be very curious myself when they come out on Friday to see if they push back. Maybe the job isn't complete and that it's premature to loosen, and that if inflation picks up, and this is my biggest fear, expectations become unanchored very quickly, and they'll have to, it will be like we cut twice, we hike twice. It'll be like we cut twice, we hike 8 times, and we have to break the economy. And, we go into a multi-year recession. It's hard to put a probability on this scenario, but I still think that tail is bigger than the recession tail. And so that's why you routinely see me talk about, inflation, all the time, and the Fed and all this stuff on Twitter. I would love to talk about other things, but it's still, to me, the biggest risk that I see is that we're prematurely loosening. Canada, for example, as you know, is a much weaker economy right now. They have 6% unemployment rate. Consumption is flatlined for a number of quarters. So there's slack in the economy, right? Like where, if they pump out 50 to 100 bips, I don't know more than that, but if they pump out 50 to 100 bips, first, the slack will get absorbed. And then you can talk about the economy overheats again. But we don't have to worry about the economy overheating in Canada right now. We don't have to worry about that. And so they can be more regular about their cutting, than we may have expected before. The Fed, on the other hand, doesn't have slack in the US economy. He pretty clearly said that. He said we're in balance. He didn't say we have a weak economy or weakening economy. He said we've seen some measures of restrictiveness. We're not very restrictive. We're in balance between our 2 mandates. So, I think you're really towing a very dangerous line in getting started here. And look, let's finger crossed, hope it all goes okay. But it is a concern, for me on that.
Yeah, totally. Well, look, Danny, it's always great to get you on here. That was a great little summary at the end there. And appreciate your insights and getting you on here. Thanks again.
Yeah, thanks again.